All right, well, it's 11:30, so let's go ahead and get started with our second PSL demo day. Thank you all for showing up virtually. So my name is Peter Metz. I'm a research associate at Harvard Business School and a contributor to a handful of PSL projects. Today I'll be going over TaxCruncher. And so if you haven't been to these demo days before, just feel free to interrupt me with any questions by either unmuting yourself or dropping your question in the chat box, which I will try to monitor throughout this presentation. Great, so TaxCruncher is a tool that allows users to calculate individuals' tax liabilities and marginal tax rates under both current law and under a customizable tax policy reform. So it's kind of like TurboTax, except that you can actually design your own tax reform. So you can see an individual's liabilities now and how they would change under tax reform. So I should mention that TaxCruncher has two endpoints. The first, which we'll be going over today, is the web application, which is hosted on Compute Studio. For the web application, you don't need any programming background. It's just entering inputs into an online form, and then the Compute Studio platform will run the calculations for you, and then you'll have it all laid out there. The second endpoint, which we won't be going over today, but we can save for a future demo day, is the Python API, which has a bit more flexibility, but as you might guess, requires some programming. So here's the agenda for today. My plan is to go over two different examples of use cases in TaxCruncher. So I'm going to drop the links to the demos in the chat box if you guys want to follow along. And so if you don't have a Compute Studio account, I would encourage everyone to create one. It takes about 30 seconds, doesn't require any credit card information or anything like that. But if you just want to follow along as I share my screen, that works too. All right, great. So I'm going to go ahead and share my screen for the first walkthrough. Let's see if I can find it. All right. So this is the Compute Studio platform, as I mentioned. This is kind of what you're going to be presented with when you visit the TaxCruncher web application page. So here's kind of, I kind of jotted these notes down. But basically, when you use TaxCruncher, you're going to enter two sets of inputs. The first set is going to be your taxpayers' demographics and financial information, basically the information needed to estimate federal income tax liabilities. And the second set of inputs is going to be your federal individual income tax reform. And so if you joined us 2 weeks ago, Matt Jensen went over how to create a reform through Compute Studio. And if you didn't join us 2 weeks ago, that's okay. I think you'll be able to catch on pretty quickly. So for our first demo, let's see. So our taxpayer is single, $500,000 in wage income. So this is high earner, $100,000 capital gains, $50,000 in state and local income taxes that they can deduct, and then $50,000 in charitable contributions. The reform is going to be actually two elements of President-elect Biden's plan. So the first aspect is going to be applying payroll tax to earnings above $400,000. And then the second provision is going to be eliminating the SALT deduction cap. And so as you might be able to see here, the first provision is going to increase taxes for high earners, but the second provision might actually decrease taxes for high earners. And so we're going to see how those two provisions interact with each other with our example taxpayer. So we're going to scroll down to the interface here. The very first thing we're going to want to do is choose our year. The reason that we want to do this first is because the policy parameters actually change for every year. And so we're going to want to set those parameter values to the correct values. And so let's go ahead and do 2021, because that's the first year that Biden could feasibly enact his tax reform. So we're going to choose 2021 and click reset. Okay, now we're ready to start entering our tax information. So our filer is single, so that's the default, so we don't have to change it there. The age of the taxpayer, it won't actually make a difference here, but let's go ahead and enter something. So let's say they're 35. Okay, so dependents, we have different options for the ages of the dependents. Our tax filer doesn't have any dependents, so we can kind of just skip over this section. Okay, and here's our income section. So income is broken up into different types of income. So we have wage income, investment income, pass-through income, and just kind of miscellaneous things that aren't in these categories above. So if you remember, our taxpayer had $500,000 in wage income. So we'll go ahead and put that in the wage income input. Our taxpayer had $100,000 in short-term capital gains. So let's go ahead and fill that in there. No pass-through income, no other income. So we can kind of just leave these defaults here, but this will kind of give you a sense of how much detail TaxCruncher can handle. And if you ever have a question about these, what does this field mean? You can always hover over this I, and it kind of gives a rundown of what should and shouldn't be included in these input fields. All right, so our next section is taxes and expenses. So these are different types of expenses that somebody claim. So our taxpayer had $50,000 in state and local income taxes, and then also $50,000 in charitable contributions. And again, even though it says other itemizable expenses, we hover over the I, and we see that charitable contributions should be included in this field. Calculation options, this is a cool one, but I will kind of mention this a little bit later once we see what the outputs look like. Okay, so that kind of covers it for our taxpayer financial information. So now we're going to scroll down here and get the tax policy parameters. So this might look familiar if you were with us a couple weeks ago with Matt. So what I like to do here is there are hundreds and hundreds of these parameters, and scrolling through each one individually can be a little bit cumbersome. And so what I'd recommend here is looking at this sidebar here, where the policy parameters are bucketed into these different groups. And so if you remember, our two policy reforms that we're looking at are applying Social Security tax to people who earn above $400,000, and then also eliminating the SALT deduction cap. Luckily, the first one about payroll taxes is right at the top. And the parameter that we care about is going to be this additional taxable earnings threshold for Social Security. If we want to confirm that we're using the right parameter, we do this I, and we see that, in fact, if we type in $400,000 here, it will apply Social Security tax to earners above that threshold. Okay, and so then the second thing that we want to is eliminate the SALT deduction cap. That's going to be under this itemized deductions category. So we have all these parameters for itemized deductions. The one that we care about is under the state and local taxes and real estate taxes heading. And we see here that in 2021, it's scheduled to be, the maximum that you can deduct is $10,000. So let's go ahead and eliminate that by typing in this value, which for PSL models is basically infinity. And so we're just going to kind of paste all the different filing types, and by doing this, we eliminate the SALT deduction cap. All right, now we're ready to actually run this. So normally I would click run and it would take about 90 seconds. And if you're following along, I would encourage you to do that. I've kind of cheated and I've already run this just to save some time. And so I'm gonna go ahead and open. This is after about 90 seconds of this is the page that you'd get. So we have these 5 outputs here. We have 2 tables and these 3 graphs. So let's start with the basic table here. So this is kind of the bottom line of what's going to happen to your taxpayer. So as we mentioned before, the 2 provisions was, good for high earners, and one, would cost them money. And we kind of see how things balance each other out here. So for individual income taxes, eliminating the SALT cap would actually result in a tax break of about $14,000. On the other hand, by applying Social Security tax to earnings above $400,000, that actually increases our taxpayers' liabilities by $12,400. So you can see these things kind of balance each other out. It looks like on the net, our taxpayer is actually getting a small tax break here. We also see the marginal rates for both income tax and payroll tax, which changed slightly from our base to our reform. All right. Now we can kind of dig into that a little bit more. So the first graph here, on the x-axis, we have taxpayer earnings. The way this graph is created is we take all of our taxpayer characteristics. So you can think about, filing status and age, capital gains, expenses. So we hold all of those inputs constant, except for taxpayer earnings, or this should really say wages. So taxpayer wages, and we increment the taxpayer wages from 0 to, it goes pretty clear. So the solid line is current law. The dashed line is the reform. The blue is, as you can see here, the individual income tax, and the green is payroll tax. So this is cool because we can see across a range of incomes, who's benefiting from the policy and who's going to have to pay more under the policy. Let's zoom out here a bit. So with this taxpayer's inputs, we see that they get a tax break in individual income tax pretty much all the way up, the income spectrum. However, starting around $400,000, they're going to have to pay more Social Security tax. I'm getting a chat. And so we can kind of see how these things balance each other out for across different incomes. Okay, now we can see tax rates similarly. So these are all clickable. So I guess let's look at income taxes first. So income tax rates, we get kind of a crazy step thing for the marginal rates, but for the average rate, it's going to be lower across the board. And as expected for the payroll tax rate, there's going to be no change until we get to this threshold for additional Social Security tax, and then we have this kind of jump up to the 12.4% Social Security tax. Okay, so tax credits aren't going to be relevant for this taxpayer, and this is kind of where we get the detailed breakdown of tax liability. So we can see everything that goes into that bottom line liability. And also actually we can break down the marginal tax rates and exactly where that's coming from. So just kind of glancing through this, we notice that itemized deductions. This taxpayer can only claim $60,000 in itemized deductions under the current law, but can claim all $100,000 under the reform. So taxable income is adjusted accordingly. Let's see. And then here we get, in this line item, we get our payroll tax increase. So we can see exactly how much is being increased. So the other thing here, if you want to go ahead and do math, you can actually calculate what the marginal tax rates are going to be like this. So you can see that in this third column here, this recalculates the liabilities for a taxpayer with $1 extra. And the reason that we do this is because we can see how much their taxes would increase with $1 extra. So, with regular tax, we can see they're in the 35% bracket, because with $1 extra in earnings, they owe 35 cents in taxes. Similarly, down here, we can see with $1 extra in earnings, they owe, 17 extra cents in payroll taxes. So that's going to be their payroll tax rate. All right. So that was our first taxpayer. Again, feel free to ask any questions, monitoring the chat, but also feel free to unmute yourself at any point. Let's go to our second taxpayer.
Hey, Peter, this is Rick Evans. I had a quick comment.
Hey, Rick.
So I put this in the chat, but in the basic table, it would be, you can kind of back this out from the detail table that you just showed. Mm-hmm. But in this case where you only made 2 reforms, it'd be nice to just show the effect on liability of the one reform and the effect on liability on the other reform. So my example is, if you made 5 reforms, have a table that shows the effect of those 5 reforms specifically. So that you, like I said, you can kind of back that out from the detail table, but the reforms you made are more specific than the broad categories in the detail table. And in this basic liabilities, as long as you don't have a long list of reforms, it might be cool to just show the individual effect of those.
Yeah, I think that's a great idea. And that would kind of help. Like I was trying to convey before, with all these, with different provisions, they kind of interact differently. And I think that would be a really nice way to break these out. So I appreciate the feedback there. Okay. So let's go on to our second taxpayer. So I'm gonna have to kind of go through this pretty quick because we only have 12 minutes left. So let's see what we're dealing with. A married filer, 2 young children, $45,000 in primary taxpayer earnings. So $0 in secondary taxpayer earnings. $4,000 in eligible child care expenses. Okay, and so our reform here, we're going to increase the EIT, the Earned Income Tax Credit phase out start, to $30,000. So the EITC is a refundable tax credit for low income people. So we're going to increase the threshold at which that tax benefit starts to decrease. The second reform we're going to look at is increasing the maximum child tax credit per child, which is a partially refundable credit. So we're going to increase that from $2,000 to $3,000, and we're going to increase the refundable portion per child from, I think it's $1,400 to $2,000. All right, so let's start filling out our information. So like before, we're going to select our year first. So here we're going to switch our marital status to joint. Again, we can enter our age, but in this particular instance, it's not going to matter. So we're just going to skip it. So we do have dependents this time. It was like a 7-year-old and a 10-year-old. And so we'll just put a 2 for number of children under 13. We don't have any teenagers or older children. So. Okay, wage income. I think it was, did I say $45,000 in wage income. We don't have this other type of income here, so we'll skip over this section. Taxes and expenses. There were $4,000 in child care expenses. And I think that's it for our taxpayer. So for our policy now, we had reform to the EITC, which is a refundable credit. So we'll just skip down to this section. Here we have the EITC. And here's going to be our phase out start AGI. And so for the sake of simplicity, let's just make it $30,000 for all numbers of kids. A married bonus, but we'll leave that be. Okay, and now for the child credit, that has its own section. So we're going down here, maximum non-refundable, we were going to bump up to 3,000. And then the additional child tax credit is the refundable portion of the child tax credit. So we're going to bump that up to 2,000. All right, so we got our taxpayer information. We have a reform. If you're following along, I would click run now, but I've already run this. So I'm just going to hop over here. All right, so our bottom line. So pretty big tax cut. So these two reforms to the EITC and the child tax credit result in a tax cut of about $4,200. So these negative amounts, it means that the taxpayer is actually getting a refund. So they get a check in the mail. Our margins actually don't change, and neither do our payroll tax amounts because we didn't have any reform to payroll tax. All right, so we have similar charts. You can see here that basically at every income, taxpayers are getting a tax cut, except all the way up here when the child tax credit phases out. So we have, let's go ahead and look at the income tax marginal rates and average rates. Actually, let's just look at marginal rates. So we can see here that marginal rates are basically lower. I guess they get higher here, but we'll kind of investigate that a bit more in the credits. But this is what would happen to your marginal rates. We can zoom out. Again, no effect for higher earners once the EITC phases out. All right, this is going to be our interesting. This one shows tax by. So the blue is going to be the EITC. You can see pretty clearly here what the effect of bumping up that the phase out threshold is. So basically this trapezoid is just extended a little bit to the right, but the slope of the phase out is still the same. And so we can see that basically our taxpayer is getting about an extra $2,000 of this refundable EITC, but slope being the same means that our marginal tax rates actually don't change as a result of this EITC reform. So now let's go ahead and look at the child tax credits. So the green is the non-refundable child tax credit, and the orange is the refundable. And so we can see that they get, so now since the taxpayer has $0 in liability, they're going to be getting the child tax credit as a refundable credit. And so we can see them here that it's bumped up here by about $2,000. Through the non-refundable portion. but eventually it's going to phase out. Let's see if we can find the phase out. Yeah, so we can see that it phases out starting at $400,000 in AGI. Okay, last but not least, we'll have our detailed breakdown again. So the two things we're interested in are the child tax credit. So this line item here is the non-refundable amount. That stays the same because the taxpayer had $0 in income in individual income tax liability in current law, so they're not going to get any more non-refundable, but they do get an increase in the refundable portion. Similarly, they'll get an increase in the refundable EITC here because we bumped up that phase-out threshold. And like we did before, we can do some mental math if we want to calculate the marginal tax rates. I won't do it all, but for example, regular tax, $1 extra in earnings results in 12 cents in taxes owed. So child tax credit, 12 extra cents in child tax credit. The refundable, so I guess these things would immediately cancel each other out. I won't go through it all, but you could, if you wanted to add up all of the, the deltas here, you would arrive at your marginal tax rate. Okay, great. So that's all I have for you today. I'd be happy to field any questions if anybody has any. Feel free to, again, chat or unmute yourself. So so Rick asked, what is the output if you click downloadable results? That's just going to download this calculation of liabilities table. All right, great. So if no one has any other questions, I would definitely suggest making an account on Compute Studio, playing around with TaxCruncher and the other models on Compute Studio. In particular, there's this one here, kind of V2 of TaxCruncher, where you only have to enter your taxpayer information and you don't have to enter any policy information, and it will calculate your taxes under Biden's plan. So that's another one to play around with. But yeah, thank you everyone for coming, and happy modeling.